said the banks thinking about lending money to each other was like a thirsty person sitting at a table with 10 bottles of water in front of him. One of those bottles is poison. So 9 are okay, 1 is poison. How thirsty do you have to be before you take a drink from any one of those bottles? And that's what was going on with banks. That's what caused this bump up to 364 basis points. They didn't want to take the chance. What interest rate do you need in order to take the risk that you might not get your money back? So if you think about a focal point, I want you to remember this slide when you're remembering financial crisis, and this describes it. This is what was happening. Now, in the meantime, I've just cut the time down here. This is now the peak, October 2008, and what's happened since then. This is good news. This period right in here is good news. We're back to long-term normal. Banks are saying we'll lend each other money overnight, 10 basis points, no problem. So what's this little bump? One word. Greece. Right? This is the period of time that the sovereign debt problem started to happen in Greece. We got inklings of what was going on in Spain, Ireland, Portugal. And it lasted for about 3 months. What's the significance here? Again, looking for trends. We're looking for indications about what's going on. What this says to me is stability is coming, but it's not there yet. This says that the credit markets, the global credit markets, are still susceptible to shocks. Now, if you'll remember what happened here, why this has now come back down to normal. We're just under 12 basis points now. What happened here was when this spread started to break out, the European Union came through with a $1 trillion package to save all these troubled countries. Sovereign debt. Now, they haven't paid it all out. They didn't need to. But over the weekend, they came together and put together $1 trillion worth of obligations towards saving sovereign debt problems. So what that tells you is the messaging that you're going to get from central banks, from Governor Carney, Chairman Bernanke, from the European Bank, is we're going to save troubled institutions. That was not what happened with Lehman Brothers. That's why we got this spread. The market was going to help itself. It was going to save itself. And today we're in an environment where central bankers are sending us messages all the time. And they're making no bones about it. They're trying to make us believe how we should behave. What is Governor Carney saying? What did he say yesterday when he came out? Don't take on debt. Don't let these low interest rates make you feel like you can take on all this debt, because if interest rates rise, you won't be able to handle it. What's he saying? He's telling you how to manage your finances. And he's doing that because he knows how detrimental it can be if people overextend themselves. So he's not sending it to us individually. It's as a group, collectively. So what I would say here, when you're reading the papers, when you hear things that Ben Bernanke, Mark Carney, and their counterparts in central banks talk about, read them with that in mind. They are sending you an explicit message with their comments. So we're looking at this again and saying this trend is okay. Global credit markets are improving, but still susceptible to this shock. So we're not out of the woods yet. So we still haven't answered the question about, is this a sustainable recovery? And I'm not going to yet. I'm just going to show you a little bit first about capital markets and what's happened since in the last 10 years. Basically since February 2001, we've charted this with these 3 years: Canada, US, and EFI. I've just used the Euro flag there to represent EFI. So the top line is Canada, the middle line is EFI, and the bottom line is the US. This is all in Canadian dollar terms. So it's just to give you a little perspective of what's gone on in capital markets, but also to talk about valuation. You'll read about valuation in the papers and they'll talk about it. One way of describing valuation is to take a long-term average, and that's what these thinner lines are through there, are 200-day moving averages. So as we're going through time, the short-term levels will go up and down above and below that 200-day line. When you hear about a stock market being overvalued, it could be that those analysts are looking at it and telling you that because it's over its 200-day moving average. So it's just a way of saying relative to where it's been, it's more costly now. Or undervalued, the converse. But, excuse me, what this is saying over time, and this effect, by the way, has a lot to do with currency and the exchange rate, the appreciation of the Canadian dollar against all international currencies, including the U.S. dollar. Another valuation method, so again, when you're hearing about valuation in the papers, is price-earnings multiple. So again, I know a lot of you know it, but just for those of you who don't, the price-earnings multiple is a way of saying that there's a price that investors are willing to pay for the stock that's a multiple of the earnings, the underlying earnings of the company. And that multiple changes because the price changes every day. The earnings don't change a lot. So when we're looking at the price, it's just a way that investors are putting a value on those earnings and whether they're sustainable longer term. So what it does is it gives us, if we look at price-earnings multiples over a period of time, it lets us know or gives us an indication of where we might be today. Whether it's over the long-term average or under the long-term average is another method of saying, is it overvalued or undervalued? Now again, Professor Schiller at Yale, who was the same one who had the home price index we talked about before, did some calculations back to 1900 and smoothed out earnings. Because you know companies go up and down in their earnings. So he smoothed them out over 10-year periods just to give a better idea of what earnings might be on a more regular basis, and then compared the S&P 500 price to what that long-term rate would be. So the long-term price-earnings multiple is around 15 times. So every dollar of earnings, investors are willing to pay $15 for stocks, on average. So if you looked at that and said, where are we today? We're at 21 times as of October 5th. It was over 21 times price-earnings multiple in the U.S. So again, there are a lot of other factors involved in valuation. But if you look at moving averages, where we are compared to moving average, and where we are compared to long-term price-earnings multiples, relatively, it gives you an idea of where the stock markets are. And that's what you're going to read about in the papers in terms of valuation. Now, my third, and I promise, well, I don't really promise, but my third geek slide, economics geek slide, is about the yield curve. So I'm going to talk to you about this because, first of all, as individual investors, it's very important to you because you should hold fixed income in your portfolios. And that's what the yield curve describes. It helps us to understand the context of fixed income investments. But the other side of it is looking at the world capital markets. And we know that the world capital markets have about $142 trillion in them. $60 trillion is equity. The rest is fixed income. The fixed income market at $82 trillion is far larger than the equity market. Far more fluid, moves a lot of money back and forth on a daily basis. So it's not only important to you as an individual investor, to the capital markets in general, it's crucial. So crucial, in fact, that James Carville, and most of you will remember him as the advisor to Bill Clinton, said that as he became more involved in national politics in the U.S. and understanding what the economy was doing, he said, and he's a power grabber, right? He loves power. He said, I used to think if I believed in reincarnation, I'd like to come back as president, a pope, or a 400 hitter. But once I became more involved in politics, I realized I want to come back as the bond market because it intimidates everybody. And it's because of its size. It's because of the influence it can have on decisions. It helps and it reflects interest rates. One of the ways we look at fixed income or the bond market is to look at yield curve. And just to quickly explain, the yield curve describes on the vertical axis the cost of borrowing, or the percentage of yield that a bond is paying. On the bottom axis, on the horizontal axis, is the maturity date.